Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about SentinelOne. SentinelOne is a cybersecurity company. It's in a very hot space of cybersecurity and it's growing at a very rapid rate. So we're going to talk about some of the good things about it. We're going to talk about one of the things that kind of puts me off here, and then we're going to bring this all together and talk about its valuation. So let's just jump right in. So one of the things that is really compelling here is that not only is the company growing at triple digits, you can see that as it comes to lapping the same period a year ago, it's actually accelerating its growth rate. As it put its guidance in September, it's putting out guidance for Q3 of growing at 142% year over year. So it's a very fast growing company. You know, this is really the appeal here. And I mean, it's impressive. I mean, you could make the case, yes, that it's working off a base of 190 million. So it's really a small player. But nevertheless, you know, so many of these companies that kind of come in, do the IPO, and then they the first quarterly result that comes out, the guidance is like anything but impressive. So this one, you know, is nice. It's good to see. So what does it actually do, right? So it's just for reference, right? So let's compare with CrowdStrike, and I'll make a few references to compare it to CrowdStrike. So CrowdStrike is, you know, as the name implies, the crowd favorite. And its growth rate for this year is approximately 60%, so it's kind of half the rate of SentinelOne, okay? So with that in mind, you can really get an impression that this company is really taking market share. SentinelOne is a cybersecurity company. It uses AI to kind of to work on the cloud, but doesn't necessarily need to only work in the cloud. It can work for the company on-premise as well, and it provides endpoint protection. So it's kind of got a lot of appeal for companies because it can do an auto deploy, which means the company doesn't need any kind of downtime to upload its platform. So there's a lot of things that here are really attractive. I put this graph here. So this is Gartner's back in May. They put SentinelOne as a leader in this space. So you know, that's again something that's very attractive. Obviously there's the heavyweight there, CrowdStrike, but you know, it's doing something really well despite being a relatively small company. The other thing that I wanted to highlight is that for me, whenever I look at a company, I want to see the adoption in customer growth. I'm not so keen, I'm not so interested to see pricing power at this stage. I just want to see the number of customers coming on board and adopting the platform, and that's really a validation to me. And you can see here, they're coming up at 75% year over year, the growth in total customers to 5.4 thousand. So it's something that's, you know, that's really cool. You know, it gives you a bit of evidence that the company is growing at a reasonable rate, and it's driven by customer adoption. You can see that the net retention rate is 129%. As a reminder, typically in SaaS, you want to see 120%. That means the company is able to upsell more revenues by 20% year over year to the same cohort that came in last year. 129% means that it's able to upsell them close to 30% more revenue over the course of a year. So you don't want to see too much of the net retention too high, because what happens then is that the companies you know, no one's pleased to get a really large bill at the end of the year, so the customers end up just churning out and, you know, not infused with the company. So this is really around that sweet spot, I think. Another thing that now, so let's discuss one of the blemishes here. So you can see that for this year, the guiding to approximately, I think is like something like negative 100% operating margin, and the long term, see that how I did that? The long term target is to get to plus 20% operating margins. This is obviously non-GAAP, so you have to add in stock-based compensation. This means that it's going to be a really long time until this company is putting out clean operating margins. So it's kind of like, it's difficult to get really compelled here. The gross margins that they kind of putting out is approximately 60%, so it doesn't have so much operating margin to kind of grow into, because the gross margin is just kind of around 60. Yeah, it's gonna get to around 70% at some point in the future, but it's gonna be really, you know, a difficult investment here to kind of get like really kind of enthusiastic about. The other thing that I wanted to highlight is just for comparison. Let's look at CrowdStrike. So on the rule of 40, CrowdStrike reaches 80%. So that means it's growing at a reasonable rate with a prudence and responsibility towards the bottom line. So anything around 40 is good, higher than 40 is excellent. CrowdStrike hits 80, and that's why people really love this company. Compare that with SentinelOne, that last quarter was 23%. So it's not even hitting the rule of 40, even though it's a really early stage of its company. But you can balance this out. You can look at rule of 40, for example, from companies that are quite profitable, like Vivo or Adobe, or you can look at companies that are growing very fast, but they're not really that profitable. So it's a good measure to kind of give you an insight into whether the company is moving in the right direction or not. So kind of in the case of SentinelOne, it's like, yeah, I'm not really kind of totally bullish here. Another thing that I want to highlight is that for the first 6 months of 21, it's burned through close to negative 80 million. So, roundabout figures, it's going to be a negative 160 million for the year. So, it's burning significant amounts of capital. It does have approximately 1.7 billion, I think I put down. 1.7 billion of cash on its balance sheet, doesn't hold any debt. But at some point in time, if you're burning through 1.7 million, 170 million of free cash flow, that implies that you're going to have to raise some capital, and it's probably going to be via share dilution. And, that's kind of like loses some of the appeal there as well. So the stock is priced at 42 times next year's revenues. That's really, really expensive, right? Just for comparison, Zscaler is the one that everyone says, oh, Zscaler is really overpriced. And in comparison, Zscaler is priced at approximately 33 times next year's revenues. I kind of use an estimate there, but it's kind of in the right ballpark, I believe. So in comparison to that, you got an unprofitable company that's priced at 42 times next year's revenues. It's really a mouthful. I mean, it's going to be really difficult to get much more expansion on that multiple. I mean, the company would really have to impress investors significantly for it to kind of get priced to close to 50 times forward revenues. It's going to be really, really difficult, I think, even in this space that's really hot right now. So with that in mind, don't forget to check out our marketplace called Deep Value Returns, and I'll tell you the stocks that I'm excited about right now, and I'll also tell you help you become a better investor, help you think through how to invest, and really offer you a hand-holding service. You're welcome to check out my reviews to see what other people have said, and I hope to see you next time. Okay, bye-bye.